with me here in our New York studio is Jeff Weiner. Just a little bit of background on Jeff. Jeff has had an amazing career. He joined Marcum in 1981 after being at Deloitte for a short time. Marcum at that point had 7 employees. The growth of Marcum started. Jeff became managing partner in 1990. He built it into a $1.3 billion firm. It was acquired in 2024, at the end of 2024, by CBiz. I can tell you he's widely recognized as an innovator, one of the leading firm CEOs, and someone who's been very, very supportive of the profession. So looking forward to the discussion, Jeff. So thanks for being with me here in New York.
Thanks for having me, Erik.
So let's just start a little bit, and let's start talking a little bit about your journey from joining that 7-person firm or 6-person firm. There's many people on the town hall right now who are in firms of that size.
Yeah, it was an overnight success that took 40 years.
Yeah.
And it was 6 people. I was the 7th person. Back in 1981, we did $300,000 of revenue. Mm-hmm. But it was, we were on a mission and we were on a journey. And we worked hard, we got lucky, and the profession changed. Private equity started coming in 2021, and all of a sudden the firm had value outside of just a retirement. So it was one of those things that it was never the intention, but it worked out.
Well, let's talk a little bit about a lot of these new business models that are emerging. You and I have had a couple of discussions on this. I mean, there's many different options. Everyone's talking about PE, but when you look at the journey of Marcum, there was a lot of things that you did to drive growth that were not PE related.
Yeah, well, but listen, we started in 1981, so that was probably 40 years before PE came into the profession. We just wanted to grow the business. We were always motivated by servicing our clients well, not having our clients outgrow us. So we always invested in 2 things, which were talent and technology. Mm-hmm. And as we kept growing and learning there were bigger clients who paid bigger fees, we kept reinvesting in the resources we needed to get those clients. Mm-hmm. So it just was a journey. We went to work every day to build the firm.
Well, Jeff, talk a little bit about investments in people and technology. When it was about 6 years ago, where you started looking at to accelerate some of those investments, you looked at some options that were available to you to help with your financing.
Yeah, it was interesting. We started on our national expansion in 2008. Mm-hmm. And prior to that, we were a New York-based firm with 2 offices. And by that time, I think we were about $100 million with 450 people. And when the recession hit in 2008, we decided that we had to look for other ways to grow besides organic, because in 2008, 2009, there was very little organic growth. And we set out on this national strategy to become a national firm. And along the way, we talked to firms bigger and smaller than us. And sometime, you said about 6 years before, I got introduced to a guy named Sam Shaw, who at the time was the CFO of Grant Thornton and today runs a company called Riveron. And Sam educated me as to the way the larger firms capitalize themselves, how they manage their balance sheet, and how they had tapped what was then the institutional market for long-term debt. Mm-hmm. And it was an interesting conversation. And I said, well, if Grant Thornton can do it, why can't Marcum?
And what size were you at that time?
This probably, we closed our debt offering in 2021. I would say we were somewhere between $600 and $700 million at the time.
Yeah.
But Sam had shared with me Grant Thornton's balance sheet, and I said, well, they're a couple of times bigger than us. So if you look at, I think they had $150 million of long-term bonds. I said, well, Marcum should have a 50. Mm-hmm. And they had a line of credit behind it. I said, well, I just extrapolated down and went to our bank. And I said, I need to get $50 million of long-term debt, and I need a $150 million line of credit. Mm-hmm. Wasn't sure what I was going to use it for, but spent about 6 months with my bank, and lo and behold, in the summer of 2021, July of 2021, we closed on a long-term debt offering with 2 insurance companies and closed on a new revolving line of credit, all of it unsecured, by the way. And we now had a war chest. And little did I know, this was July of 2021, little did I know a month later, my friend Charlie Weinstein was going to go bring the first private equity deal into the accounting profession. So I always tell people sometimes it's better to be lucky than good. But what that did is the long-term bonds coupled with the revolving line of credit gave us the war chest to be able to do the same things that Charlie and then Joe Cooperman did with Citron. We had the capital to go out and compete with them and continue to do mergers and acquisitions.
So when you think about, the large G400 group, the 400 firms below the top 100, or even firms smaller than that, do you think, looking at financing options is something that they should consider when they're looking at M&A or tech investments?
Yeah, I think certainly we were of a certain size when we did it. So a $30 million firm is not going to be able to go tap the public markets for debt like a $600 million firm was able to do. But I think, if you look at business, debt is always cheaper than equity. So while private equity coming into the profession, I think, has been a great thing and will continue to be a great thing, bringing in equity is always more expensive than bringing in debt. So I remember back in 2010, we were a much smaller firm. We were probably closer to 200 million, which is still bigger than a lot of firms. And we had the opportunity to buy the UHY practice in New England. Now, at the time, that was a 20-some odd million dollar firm, but UHY was interested in selling it and wanted cash. So we got a very attractive price from UHY. And we went to our bank at the time and said, can we borrow $10 million to buy this practice? We had never borrowed money before, but it was well worth buying the practice, paying back the loan, and the revenue less the expenses and paying back the loan still made money for Marcum. So we borrowed money at the bank. It was a secured loan. I think we signed our names away, but it was probably one of the best investments we ever made. So borrowing money is not bad if it's for growth and you understand the payback.
Yeah, well, I've heard you say that before. It's critical. You want to use the debt to grow the business and have payback potential. So sometimes maybe using the financing to do a huge tech investment that could have a lot more risk.
It could have risk, but we always looked at why we were borrowing the money and what the return on it was going to be. And we used a lot of consultants over the years, and back in the day, we had Jay Nisberg at one of our retreats, and Jay drew a sailboat up on the whiteboard and then drew the water line. You're a sailor, you'll understand this. And Jay put a couple of X's in the sailboat, one above the water line and one below the water line. And I'll never forget this. He says, if you take a risk below the water line where the X is and you put a hole in the boat, what's going to happen?
It's going to sink.
It's going to sink. Yeah. If you take a risk above the water line and there's a hole, well, you'll have to repair it. You'll have some fiberglass bills, but you're not going to sink your boat. And I always remembered that. So, every time we took a risk, whether it was borrowing money, whether it was making an investment, no matter what it was, opening an office, we always tried to make sure that the risk we were taking wasn't going to sink the boat.
Some good advice. Well, let's kind of step back a little bit and talk about how you're seeing the M&A environment. There's a lot going on. There's many PE firms that have acquired an accounting firm. A lot of those firms are looking to make other acquisitions, so it's a very dynamic period.
Yeah, no, I think it's great. I credit Charlie for having the foresight to realize we needed outside capital in this profession. For a long time, I said the public accounting business model was antiquated, from the way we compensate people to the way we think people are going to stay with our firms for 30 or 40 years and retire, to the way we capitalize it. Private equity, when Charlie and Joel did their deals in 2021, the starting PE multiple was 10 times earnings to come into the accounting profession. I spoke to my friend Alan Colton the other day, and he was telling me that the latest multiples are closer to 14 or 15. So private equity has come into the profession. They realize there's a value to our companies. The multiples have gone up. There've been a probably 15 or 20, I would say, platform firms. The Eisner Ampers, the Citron Coopermans, the Cherry Beckerts, the Cohn Resnicks, and the Baker Tillys that have become platform firms. And all those firms have gone on acquisition binges and brought in smaller firm. There's also the roll-ups that I call them, the Ascends, the Cretes. So what it's done is created a liquid market for accounting firms that did not exist before 2021. The multiples have seemed to stabilize. You know, the run-up from 10 to 14 has seemed to stabilize. The big platform firms there's not as many of them because a lot of them have gone private equity already, but there used to be 44,000 accounting firms. I don't know the number today, but all of those platform firms and some of the roll-ups are looking for those firms to, and it's a simple model, Eric. If the multiple for the big firms is 14, well, they're buying those firms at 10, 11, or 12, and there's an arbitrage between buying a smaller firm and rolling it into a larger firm, and that's how they're creating value.
Well, Jeff, one thing that you and I talked about earlier today was just the value opportunity. And that's why, all the PE money's coming in is because they see value, the opportunity with technology now. It's exciting. We talked a little bit about that earlier. So how are you seeing the role of technology, the role of AI with these firms, with the value creation opportunity?
Oh, it's tremendous. And I said it earlier, we were always big believers in technology. And technology has changed the kind of work we do. When I started in this profession, we used to do tax returns by hand. Yeah. We used to, reconcile bank accounts with pen and paper. Technology has taken away some of the boring work. When at Marcum, before AI and before the adoption of technology, a first-year tax associate would sit at a computer and input tax data, W-2s, 1099 brokerage statements. Today, the computer does all that. You scan it. You can even download it from a broker or an employer. The tax return gets populated by machine, not by a kid out of college sitting there doing key punch. They hated that work. It was a terrible first-year experience. So now technology takes care of populating the tax return, and the first-year kids are reviewing it and thinking about it. They'd much rather do that than be a key punch operator.
Yeah, and now moving into advisory, the ability to kind of better support the clients with all of this information. In particular, right now, tax research, we're seeing tremendous opportunity with the large language models.
Yeah, you can go on ChatGPT on your computer and ask them about some IRS code. It'll print you out pages. You don't have to. You have to read it. You have to understand it. You have to make sure it's right. Yeah. But it saves you a lot of the time. So it's a time saver, and it will convert people from doing boring rote work to actually thinking and consulting and make the profession more interesting.
Well, how about a quick comment? You and I talked about a lot of firms are always thinking efficiency, but in some ways that's a race to the bottom. You really need to think about the value and the evolution of the service that you can deliver based on these new capabilities.
Right. So, it takes just a simple thing like a tax return. If somebody was paying you $1,000 for a tax return and it was costing you $600 without technology, they're still willing to pay you $1,000. If you can reduce the cost of delivery, let's say using technology, you can reduce the cost of delivery down to $100. But they're still willing to pay you $1,000. What else can you do for them that they will appreciate? What's the value add you could add on top of that tax return to give the client so you give them better service, you give them value, and you don't reduce your revenue? You have to be smart about it. Accountants have a tendency to want to charge less, and that's the reason that someone's hiring them. I would tell you charge more and give the client a reason to pay you more rather than less.
Well, and those are the kinds of things that we're thinking through, just the evolution of the services. You need to change the service. You can change it, if it's an annual tax service, change it potentially to a subscription tax service where you're just giving continual advisory input on how they can, drive a more successful business. Well, let's talk a little bit about leadership. I mean, you've thought a lot about this over your career. So maybe some leadership principles for the town hall community?
Well, leadership is a tricky thing. You can't lead unless they're willing to follow. That's number one. You have to remember what your job is and make it not all about you. You can certainly reap the benefits, but if you're going to lead, you have to create an environment that people want to work in. And I will tell you, before we sold to CBiz at the end of 2024, we had 4,000 people at Marcum. It wasn't a place for everybody. It took a certain person. We were highly accountable. We were highly motivated. So if you wanted to hide, if you didn't want to succeed, it probably wasn't the place for you. But for the people that wanted to be there, it was the best place to work in public accounting. And my obligation was to create the environment that these people could work and succeed, that supported them, that provided them the resources they need, where we could get the clients we wanted. But leadership is a big responsibility. And every night I went to sleep knowing I had to support 4,000 people and make sure that every 2 weeks they could get paid, manage that balance sheet. But we had 4,000 people working for us, which means that we were paying 4,000 mortgages or rent. We were probably paying 7,000 or 8,000 car payments. We were feeding, if you extrapolate out with kids and stuff like that, probably 10 to 12,000 people a day. And when you realize the enormity of the responsibility, you realize leadership is not just about getting up in front of the room and speaking and getting a big paycheck, but it's the responsibility that comes with it. And the people who are sitting in the audience, the people who are working with you, are entrusting their career, their livelihood, their well-being to you, not screwing it up.
So if someone's starting out today, what advice would you provide them?
It's interesting. I've said this before, but I have 2 older children. And my second son, Leo, works for TD Bank. He's had that job. He's 31 years old, and he has that job since he came out of college. And when he started his job, I said, Leo, I'll give you 3 pieces of advice that no matter what job you have, what career, or what your aspirations are, if you want to succeed, there were 3 simple things to do. And back 10 years ago, it was be the first one in, be the last one out, and whatever they ask you to do, do more. And I think those hold true for whatever profession or industry you're in. When COVID happened and people started thinking, well, working from home is the end all and be all, I added a 4th to that, and that was show up. People have to know your name. So, Leo would make sure that anyone in the office who he worked with knew his name was Leo. So this way, business goes in cycles. And anyone who thinks when the down cycle hits and they're looking to, thin out the herd, the people they know, the people they see are going to be the last people on that list. If, you may do great work, but if they don't know you, there's no connection. Yeah. That's a problem. So be the first one in, be the last one out. Whatever they ask you to do, do more and show up.
Well, Jeff, thanks for sharing these reflections. It's great of you to come into the studio. You are missed by many. I've been at a few events, and recently there was a big large firm event, and it was the first one you hadn't been at in a number of years, and your name was brought up by many. So thanks for your leadership. Thanks for being here with us today.
Thanks for having me, Erik.
Thank you.